But first this, markets are lower this morning, as you can see on this, the last trading day of the third quarter. This after personal income and spending data just hit the wire, and a GDP number yesterday that was in line with expectations at growth of 4.2%. That was the final reading of the second quarter. Joining us right now is Roubini Macro Associate CEO, NYU Stern School of Business Professor, economist Nouriel Roubini. Great to see you, Nouriel. Thanks so much for being here.
Great being here, Maria.
Your characterization of the economy right now and what you're expecting in the next year.
Well, the economy is doing well right now. Expected to grow 3% this year, slightly less than 3% next year, but I expect actually we're going to have a stall of growth and possibly a recession by 2020, and that's due to many factors. In my view, the economy is growing 3% only because we have a fiscal stimulus that is 1% of GDP this year and next year. By the end of next year, we have a massive fiscal cliff that is more than 1% of GDP, and I don't think that fiscal cliff is going to be addressed easily. We'll have the Fed hiking from 225 all the way to 350. The economy is obviously overheating. You have the trade wars that are going to escalate. This is not just a trade war. We'll have something of a Cold War with China on trade, on investment, on technology, on IP, on everything. And it's not going to be just with China. It's going to be with our allies and all the rest. This president was voted in on Buy American, Hire American. He's protectionist. And there's a whole bunch of other stagflationary policies that are going to slow down growth and are going to increase inflation, restricting inward and outward FDI restriction to migration. We don't have an infrastructure plan, and so on and so on. And EM is going to slow down, and it's slowing down. China's going to slow down.
Were you expecting the economy to fall apart when Donald Trump was first elected?
No, I was not expecting to fall apart, no.
But were you expecting things to lessen? I mean, his economic policies, when you look at the tax cuts and the rolling back of regulations, have helped the economy. I'm just trying to understand better why you see this fiscal cliff happening next year.
Well, first of all, you know, the CBO, that is independent, actually led by Republicans, said the impact of the tax cut on potential growth is going to be close to 0.1% over 10 years, and it's temporary. You have a stimulus for the first 2 years, and the way it was designed was to maximize the stimulus by the time of the midterm elections. And then you're going to have a severe fiscal cliff because the way they were designed it was to be revenue neutral by the end of the decade. And therefore, for 2 years, you have a massive stimulus. If you look at the data, 1% of GDP. Then you have a drag in 2020. And the drag becomes actually severe drag by 2025. That's the way it was designed.
He's on the other side of that trade.
I have I want to clarify a couple
These are the
things.
numbers. I mean, it's not the question.
Your rhetoric almost says depression. But you said recession.
Yeah.
Isn't by definition most recessions pretty short and not that severe?
Well, you know, this time around, I think that the risk is that if and when we're going to have that recession, it might be as severe as the previous one, or it could be worse. And it could be worse for two reasons. One is that today in the U.S. and globally, debt ratios are higher than they were before the global financial crisis. Debt ratio have gone globally, private and public, from 160 to 260% of GDP globally. So it's a much more bigger debt problem. Debt servicing ratios are low because interest rates have been low, but now the Fed is normalizing, other central banks are normalized. So with higher nominal and real rates and high debt ratios, we're going to see like corporate debt.
You're saying this recession could be worse than the previous recession.
Could be. And second factor is important, just if I could make the point, is that we're constrained in terms of policy tools. We run out of policy bullets. The headroom on policy rates is not going to be 600 basis points. It's going to be at most 300. Fiscal policy, we have another $2 trillion of debt and deficit even before the next recession. And the political willingness to backstop and bail out banks, corporates, households is going to be constrained. And some governments are insolvent. So policy tools are being more constrained. Debt ratios are higher, and financial vulnerabilities are higher.
I agree. I think you've done fantastic research, and your facts are right. But didn't you say a lot of that stuff right before the bottom of the market in 2009? That you said the worst was yet to come, and we've had one of the greatest rallies in the stock market in the last 8 years, and in the economy, and that's despite the restrictive policies that Obama had.
I never predicted until now that there'll be another global recession. Even when there was a risk of a hard landing in China in 2015 and 16, I said China is the policy tools. When there were worries about Brexit in 2015, I said Greece is not going to exit the Eurozone. Eurozone is going to collapse. So this time around, when I look ahead, I see 10 factors. It's fiscal policy, it's monetary policy, it's trade wars, it's other stagflationary policies by the U.S. administration, slowdown in EM, slowdown in China, slowdown in Europe. Look what's happening this morning with Italy, with the doom loop between the banks and otherwise. And we have frothy asset prices. Nothing is cheap. Public equities are not cheap. Private equity is not cheap. Real estate is not cheap. Credit spreads are not cheap. Government bonds are not cheap. CAPE, the cyclically adjusted P ratio, is 50% above historical norms. So we know there'll be a correction, and we know that there is illiquidity in the market. And we also know that policy tools are constrained, and we have more debt.
The World Trade Organization is cutting its outlook for global trade due to the increasing trade tensions around the world, but this because largely this tit for tat in trade. But we had a guest on the other day, Dagan, who basically said the risk is to the upside as a result of these trade talks, right? He was saying that if President Trump gets a win with Europe, with Canada, with Japan, these markets will rip.
There is certainly a possibility that it's just a negotiating ploy out of the deal. But if I read what the U.S. is saying, the U.S., if you read the new national security strategy of the U.S., they say China is a strategic rival of the U.S. And if we let China win the industry of the future, it's a threat not just to our economic security, also to our national security. It's a containment of China strategy. It's trade, is investment, is FDI, is technology, is joint ventures, is across the board. This is a new Cold War that is economic, financial, political, and geopolitical. I think markets are underestimating that we are on a collision course with China, and not just with China. I think this is an administration that is protection. It's buy American, hire American.
China's
America first, make America great again. This is a protectionist administration. Gary Cohn is gone. You have Peter Navarro, you have Ratzinger, you have the president, you have Wilbur Ross, who are protectionists.
I don't know how that leads, but I don't know how that leads to a recession. That's what I'm saying.
That's
China,
not alone, but I spoke about 10 other factors.
Yes, you did.
In addition to it, there is also stagflationary shocks coming from trade, investment, migration that reduce growth and increase inflation. And the Fed will have to hike more given stagflationary shocks.
Okay, so China actually has already slowed somewhat, but the United States GDP is 40% bigger than China. It seems to me we are now seeing for the first time massive increases in sentiment, which have led to booming consumer spending and investment by corporations, which we haven't seen really in 10 years. Seems to me that's a very forceful propellant for the next couple of years.
Because of the rollback in rates.
It is positive.
And deregulation.
It is positive, but household sector, as we know, the tax plan makes the tax cuts on the corporate permanent, while after 2020, the tax rates on the household gradually go higher and higher than they were before because they had to pay for this 1.5 trillion to make sure that after the 10-year decade, there's not going to be another deficit. So the way they did is by making permanent the tax to the corporates and making temporary the tax on the household sector. So you have a short-term stimulus to the household.
Nouriel, we got to jump.